Hey everyone, and welcome back to the Deep Dive.
Great to be here.
Today we're really going to cut through some of the jargon. We want to get straight to what you need to understand about how trust is built, in the financial world.
hmm
We're diving into these essential concepts that underpin how auditors make those really crucial judgments. Things like what really matters in financial statements,
Yeah, what's significant?
the inherent risks they navigate,
Yeah.
and that ever-present tricky challenge of fraud.
And understanding these concepts, it's like getting a VIP backstage pass, really, to how financial information gets its stamp of approval.
Oh, I like that analogy.
It gives you this powerful lens to view any company's reports,
Yeah.
helps you figure out what genuinely influences a user's judgment quickly.
Absolutely. So our mission here is to unpack these ideas, make them clear, actionable, and honestly pretty easy to grasp.
Yeah.
You'll walk away with a true shortcut to being well-informed about the integrity of financial reporting. Let's get started.
Let's do it.
So let's kick things off with a fundamental concept in auditing: materiality. When auditors talk about materiality, what are they essentially asking?
They're asking, how big does a mistake or an omission have to be to actually matter to someone making a decision based on those financials? It's all about what influences a, quote, reasonable user's judgment.
Okay, the reasonable user.
That's the core of it. The U.S. Supreme Court actually weighed in on this for federal securities laws. They defined a fact as material if there's, and I'm quoting loosely here, a substantial likelihood that the fact would have been viewed by the reasonable investor as having significantly altered the total mix of information available.
The total mix, so it changes the whole picture.
Exactly. Think of it like, well, a typo in a tiny newspaper ad probably isn't material, right? But a wrong number in the main stock market report, that is. It significantly alters that total mix for a reader making investment decisions. It requires these really delicate assessments, as the court put it.
That's a great way to put it. And these reasonable users, they're not just some vague idea, right? Auditors have assumptions about them.
Oh, definitely. There are specific assumptions. These users, they're assumed to have, appropriate knowledge of business, the economy, and crucially, generally accepted accounting principles.
The rule book.
The rule book, yeah. They also recognize that financial statements inherently include some uncertainty. You can't be precise down to the last penny always.
Right. Estimates and judgments.
Exactly. And they understand how materiality affects both the preparation of the statements by the company and the audit by us. And importantly, they have the willingness and the ability to actually analyze the information and make judgments. They're engaged users.
Okay. So given those assumptions about the user, how do auditors then determine these different levels of materiality? You mentioned levels.
Right. It's not just one number. First, there's the materiality for financial statements as a whole. That's the big overall threshold we've been talking about.
The main headline number.
Kind of, yeah. But then, very importantly, we have performance materiality. Now, this is an amount, or amounts, set lower than that overall materiality.
Oh, or why lower?
Good question. It's set lower to reduce the probability to an appropriately low level that the sum of undetected and uncorrected misstatements might actually exceed the overall materiality for the financials as a whole.
Ah, so it's like a buffer, a safety margin.
Exactly. It's a buffer, a safety net under your safety net, as you said before we started. It helps ensure the fieldwork catches enough potential issues.
Got it. And can it get even more specific? Like, are some items so critical that even a tiny error is a big deal, regardless of the overall number?
Absolutely. That's where materiality for particular classes of transactions, account balances, or disclosures comes in.
Okay.
This is for specific line items or notes where misstatements of amount even less than the overall materiality could reasonably be expected to influence the economic decisions of those users we talked about. Think related party transactions maybe, or key disclosures about debt covenants.
Things that are super sensitive.
Yeah, precisely. And the PCAOB standards, that's the Public Company Accounting Oversight Board, setting rules for audits of public companies, they specifically require auditors to determine if there are such accounts or disclosures that need these separate, even lower materiality levels.
Okay, so it sounds like setting materiality isn't just, picking a percentage. How do they actually decide on these numbers? What factors are they weighing?
It's definitely not picking numbers out of a hat. It boils down to professional judgment, considering both quantitative and qualitative factors.
Qualitative, like what?
Like maybe a misstatement affects compliance with a loan agreement, or changes a loss into income, or impacts management compensation. Even if the dollar amount is small, the nature of it could be material. Quantitatively, they need to express it as a specific amount. And a key principle is using the smallest level of misstatement that could be material to any one of the financial statements being audited.
The smallest level across any statement.
Okay. Yeah, you have to be conservative because users look at different parts, the balance sheet, the income statement.
So what are some of those benchmarks and factors they look at?
Well, quantitatively, a common starting point is applying a percentage to a relevant financial benchmark. Maybe 5% of profit before tax, or 0.5% of total revenue, or 1% of total assets.
And how do they choose the benchmark?
It depends on what users of that specific company's financial statements tend to focus on. For a mature, profitable company, profit before tax might be key.
Yeah,
For a startup, maybe revenue or assets are more relevant.
makes sense.
They also consider qualitative factors like the nature of the entity, its industry. Some industries are inherently riskier, its size, ownership structure, how it's financed. Past results, budgets, forecasts all play a role. And of course, any big known or expected changes, a merger, a new regulation, an economic downturn that
Yeah.
could shift what's important to users.
Okay, now building on that, there's another term, tolerable misstatement. How does that fit into this picture?
Tolerable misstatement. It's closely related but distinct. It's essentially the application of performance materiality to a specific audit procedure, often one involving sampling.
Okay, so it's
In fact-
practical application.
Exactly. It's
Yeah.
the maximum amount of error the auditor is willing to accept or tolerate in that specific sample or population they're testing, like accounts receivable confirmations, for instance. And it still ensures that the financial statements overall aren't materially misstated.
Right.
And importantly, for audits spread across multiple locations or business units, the tolerable misstatement set for each location must be lower than the overall performance materiality. You have to aggregate the risk.
Let's try and make this really concrete with that example you mentioned earlier. Evan at Noah CPA firm auditing a client in year 2.
Right.
His firm's guideline says overall materiality is the larger of 1% of total assets or 0.5% of gross revenue. And tolerable statement is 70% of that overall number if they think the likelihood of uncorrected errors is low.
Okay.
The client has $2,500,000 in revenue and $1,750,000 in total assets. So how does Evan calculate it?
Okay, so first, the benchmark. 1% of assets is $17,500. 0.5% of revenue is $12,500. The firm says use the larger percentage applied to the appropriate base, but here the revenue base is larger and using the 0.5% yields $12,500. Let's assume the firm policy means apply the percentages and pick the larger result, or perhaps a specific base is usually prioritized. If we follow the text strictly, 0.5% of revenue is $12,500. Let's assume that's the overall materiality based on firm policy or judgment for this client.
Okay, $12,500 overall materiality.
Right. Then Evan assesses the likelihood of undetected misstatements as low. So the firm guideline says use 70% for tolerable misstatement. So $12,500 times paint shipment, that gives him $8,750.
$8,750. It's driven by firm policy, but also requires that professional judgment based on this specific client. It's a tailored approach.
It really is. And you mentioned group audits earlier, companies with lots of subsidiaries. How does materiality work there? Is it just the same process? Similar concepts, but with added layers. The group engagement team sets the overall group materiality, group performance materiality, and materiality for any particularly sensitive group-level items. Then they also have to determine component materiality for each individual subsidiary or significant component being audited.
Component materiality.
Yes, and critically, component materiality must be set lower than the overall group materiality. It ensures that the work done at each part of the business is rigorous enough when considered altogether.
So it all rolls up correctly.
Okay.
One last thing on materiality is it's set once and forgotten?
Absolutely not. That's a key point. Auditors are constantly revising the assessment of materiality throughout the audit.
Why would they change it?
Well, maybe the initial estimates they used for benchmarks turn out to be significantly different from the actual year-end results. Or maybe new information comes to light, changes in laws, regulations, contracts, or even just major shifts in the business that could change what investors care about. Materiality is dynamic, not static. It has to be relevant at the time the audit report is issued.
Okay, that makes a lot of sense. It's an ongoing assessment.
Definitely.
So once an auditor has figured out what truly matters, the materiality levels, the next huge challenge is, well, how do they make sure they don't miss something that big?
Exactly.
And that brings us to audit risk. What is audit risk, fundamentally?
Audit risk is the risk that the auditor expresses an inappropriate audit opinion when the financial statements are actually materially misstated. In simple terms, it's the risk of giving a clean bill of health when, in fact, there's a significant problem the auditor didn't catch.
So risk of being wrong.
Precisely. And it's crucial for listeners to understand. Auditors aim to reduce this risk to an acceptably low level, but they only obtain reasonable assurance, not absolute certainty. An audit isn't a guarantee.
Reasonable, not absolute. Got it.
And to understand audit risk, you need to understand what constitutes a material misstatement. We touched on materiality, but a misstatement is basically an omission or error in accounting information that, considering the circumstances, would probably change or influence the judgment of a reasonable person relying on that information.
Okay. And can these misstatements be accidental or deliberate?
Both. They can result from errors, which are unintentional mistakes, maybe a calculation goof-up or misinterpreting a fact, or they can result from fraud, which is an intentional act to deceive. That distinction is hugely important, as we'll discuss later.
Right. And what kinds of things count as misstatements?
Oh, it's a broad category. Inaccuracies in gathering or processing data, departures from GAAP, omitting information that should be disclosed, making incorrect accounting estimates, or choosing accounting policies that aren't appropriate, even just classifying information incorrectly.
Wow. Okay, so are all misstatements created equal in the auditor's eyes? Or are there different types they categorize?
Good question. Auditors do tend to categorize them. There are factual misstatements where there's just no doubt. The invoice says $1,000, the ledger says $100. Clearly wrong.
Black and white.
Pretty much. Then you have judgmental misstatements. These arise from differences in judgment between management and the auditor regarding accounting estimates, or the selection or application of accounting policies. Think estimating bad debt expense. There's inherent judgment there.
Gray areas.
Definitely more gray. And finally, there are projected misstatements. These are the auditor's best estimate of the total misstatement in a whole population, like all sales transactions based on the errors they found when testing just a sample of that population.
Projecting from the sample to the whole.
Exactly. You extrapolate.
Okay, so all these potential misstatements feed into this concept of audit risk. And you mentioned there's a model auditors use.
Yes, the audit risk model. It's a conceptual framework often expressed as audit risk AR equals the risk of material misstatement, RMM, multiplied by detection risk, DR.
So AR, RM, XDR, let's break that down, was RMM.
RMM, the risk of material misstatement, is the risk that the financial statements are already materially misstated before the auditor even starts their work. It's the client's risk, assessed by the auditor.
The risk inherent in the company and its systems.
Exactly. And RMM itself is made up of two components. Inherent risk, IR, multiplied by control risk, CR.
Okay, IR times CR. Let's start with IR, inherent risk.
Inherent risk, IR, is the susceptibility of an assertion about an account balance, class of transaction, or disclosure to a misstatement that could be material before considering any related internal controls.
The four controls, so just the raw riskiness.
Yeah, think of it as the inherent risk temperature of that area, what makes it riskier. Things like high complexity, significant judgment or subjectivity involved, susceptibility to change or uncertainty, potential for management bias.
Like complex derivatives, maybe.
Yeah.
Or large cash balances.
Perfect examples. Complex calculations, significant estimates, high volume transactions, even unusual or non-routine transactions. They all tend to have higher inherent risk. And crucially, auditors cannot change inherent risk. It just is. They can only change their assessment of it.
Okay, so IR is the raw risk. What's CR, control risk?
Control risk, CR, is the risk that a misstatement that could occur and that could be material will not be prevented or detected and corrected on a timely basis by the entity's own internal control system.
So this is about how good the company's own checks and balances are.
Precisely. How good are their internal fire alarms and sprinkler systems? But remember, some level of control risk always exists because no internal control system is perfect. There are inherent limitations: human error, collusion, management override.
Right. Controls can be bypassed.
They can. Auditors assess control risk as high if the company has no effective controls for a particular assertion, if the controls they have aren't working properly, or sometimes if testing the controls just isn't efficient and the auditor decides to rely solely on their own direct tests.
And like inherent risk, auditors can't change control risk itself.
Correct. They just assess it. They assess how well the company's controls are designed and operating.
So RMM, IR, XCR, is the risk. The statements are already wrong before the audit. What's the last piece, DR?
Detection risk, DR. This is the risk that the procedures performed by the auditor to reduce audit risk to an acceptably low level will not detect a misstatement that exists, and that could be material.
Ah, so this is the risk the auditor's work won't catch the error.
Exactly. And here's the key insight. Detection risk is the only component of the audit risk model that the auditor can directly influence or control.
They control this risk. How?
By adjusting the nature, timing, and extent of the audit procedures they perform. More work, better work means lower detection risk. But like control risk, some detection risk always exists. Auditors rarely examine 100% of transactions, and there's always potential for mistakes in applying procedures or interpreting results.
Okay, so putting it all together, what's the overall effect on the audit? How does judging these risks impact what the auditors actually do?
It has a huge impact. The auditor's assessment of the risk of material misstatement, RMM, directly influences decisions about staffing the audit. You need more experienced people for high-risk areas, the level of supervision required, and the overall scope, nature, and timing of the audit procedures. Higher assessed risk means more audit effort.
Which leads to this critical idea, the inverse relationship of RMM to DOC-RMO. Can you explain that? It sounds important.
It's absolutely fundamental. Think of it like a seesaw. If the assessed risk of material misstatement, RMM, is high.
Meaning high inherent risk, high control risk, or both.
Exactly. If RMM is high, the auditor must set their target detection risk, DR, to a low level. To compensate for the high client risk, the auditor has to accept only a low risk of their own procedures, failing to find a misstatement.
Low DR means more work for the auditor.
Precisely. More extensive testing, more persuasive evidence needed. Conversely, if the auditor assesses RMM as low, maybe the client has strong controls and the area isn't inherently risky.
Then they can relax a bit.
Well, they can justify accepting a higher detection risk. They can perform less extensive procedures because the risk of material misstatement existing in the first place is lower. There's also a direct relationship between RMM and the amount of assurance needed from substantive procedures higher order. RMM means you need more solid evidence from your own tests.
Okay, inverse relationship between RMM and DOC-R.
Yeah,
Direct relationship between RMM and the amount of substantive testing needed.
you got it.
And you said the auditor controls detection risk. How exactly do they adjust their approach to lower it when needed?
They manipulate the nature, extent, and timing of their audit procedures.
Nature, extent, timing. Okay.
For nature, they might change from less effective procedures to more effective ones. For example, instead of just reviewing internal documents, they might directly test transactions with independent third parties, which is generally more reliable.
Okay. What about extent?
Extent usually means sample size. To lower detection risk, they'd use a larger sample size. Test more items.
More items, lower risk of missing something,
Yeah.
and timing.
Timing. Performing substantive tests closer to the actual year-end date provides more assurance than doing them at an interim date, say a few months earlier.
Closer to the finish line gives a better picture.
Right. But it's critical to remember, even if the auditor assesses control risk as low and plans to rely on controls, they must always perform some substantive procedures for all relevant assertions. You can never rely solely on control.
Never just controls, always some direct testing. Got it.
Mm-hmm.
So if you were to quickly summarize the steps in assessing audit risk.
Sure. It's roughly step 1. Determine the acceptable level of audit risk. This is usually set very low by the audit firm's policy. Step 2. Assess the risk of material misstatement, RMM, which involves assessing inherent risk based on understanding the client.
Their business industry.
Right. And assessing control risk based on understanding and possibly testing their internal controls. Step 3. Combine those to get your overall RMM assessment. And step 4, determine the appropriate level of detection risk, DR, using that inverse relationship. If RMM is high, DR must be low and vice versa. That DR level then drives the audit plan.
Let's use that example again. Katie auditing Sweet Strawberry's investment account.
Okay.
She notes they engage in complex derivative transactions. What does that tell her immediately?
High inherent risk. Complexity is a classic IR factor.
Right. Then Katie tests their internal controls over these derivatives and finds they are not operating effectively.
Okay, so that means high control risk as well.
So high inherent risk, high control risk.
Ah.
What's her conclusion about RMM?
Her assessed risk of material misstatement, RMM, for assertions related to that investment account is high.
And because of that inverse relationship.
She must set her acceptable level of detection risk too low, meaning Katie has to do more work and better work on that account. She needs to obtain more persuasive audit evidence. That might mean testing closer to year-end, definitely increasing her sample sizes, maybe seeking direct confirmation from counterparties, getting expert valuations. She needs to design her procedures to keep her own risk of missing something very low to compensate for the high risk associated with the client's situation.
That really brings the model to life. Okay.
It does. It drives the whole audit strategy.
Now let's shift gears slightly, though it's closely related. Let's shine a bright light specifically on fraud risk. You mentioned earlier the critical distinction is fraud versus error. Remind us what that is.
The key difference is intent. Fraud is an intentional act by one or more individuals, management, employees, third parties involving deception to obtain an unjust or illegal advantage. Error is unintentional, a mistake.
Intentional deception. That changes everything.
It really does.
Yeah.
And when auditors talk about fraud relevant to the audit, there are generally two main types. First, fraudulent financial reporting. This is intentional misstatements, including omissions of amounts or disclosures in the financial statements designed to deceive the users, like investors or creditors.
Cook in the books.
Essentially, yes. It often involves management manipulating accounting records, misrepresenting significant information, or deliberately misapplying GAAP to make the company look better than it is.
And the second type.
Misappropriation of assets, sometimes called defalcation or employee fraud. This is basically theft of a company's assets, where the theft causes the financial statements not to be presented fairly in accordance with GAAP.
Stealing stuff.
Yeah, stealing cash, inventory, intellectual property, causing the company to pay for goods or services never received. It can be done by employees or management.
Got it. Now, there's often talk about the conditions present when fraud occurs. The fraud triangle.
Ah, yes, the fraud triangle. It's a classic model. It suggests that three conditions are generally present when material misstatements due to fraud occur.
What are they?
First, incentives pressures. There's some reason or motivation to commit fraud. Maybe management is under intense pressure to meet unrealistic earnings targets, or an employee has significant personal financial debts.
Reason. Okay.
Second, opportunity. Circumstances exist like the absence of controls, ineffective controls, or the ability of management to override controls that provide an opening for fraud to be perpetrated.
A chance to do it. And third,
rationalization attitude. Those involved are able to rationalize the fraudulent act as being consistent with their personal code of ethics, or they possess an attitude or character that allows them to knowingly commit a dishonest act. The company owes me this, or it's just temporary borrowing, or everyone does it.
incentive, opportunity, rationalization.
The triangle.
Exactly. And auditors look for the presence of these factors. The risk is often considered highest when all three are present, but fraud can occur even if only one or two are obvious. Now, given that fraud is intentional and often involves concealment, how does this affect the auditor's ability to provide assurance? You mentioned reasonable assurance earlier.
It makes it much harder. Because of concealment, collusion, and the judgment involved, there's an unavoidable risk that even a properly planned and performed audit might not detect a material misstatement resulting from fraud.
So the risk of missing fraud is higher than missing an error.
Generally, yes, especially management fraud, because managers are uniquely positioned to override the very controls designed to prevent fraud. If the CEO tells someone to book a fake sale, it's harder to detect than a simple clerical error. Collusion also makes detection incredibly difficult.
Okay, so let's talk responsibility. Who's ultimately responsible for dealing with fraud?
Well, primary responsibility lies with management and those charged with governance, like the board or audit committee. They are responsible for designing and implementing programs and controls to prevent, deter, and detect fraud. They set the tone at the top.
And the auditor's role?
The auditor's responsibility is to plan and perform the audit to obtain reasonable assurance about whether the financial statements are free of material misstatement, whether caused by error or fraud. That requirement to consider fraud is explicit and crucial. It requires an ongoing assessment of fraud risk throughout the audit.
And a key part of that is maintaining professional skepticism, right?
Well,
What does that really mean here?
it means having a questioning mind and performing a critical assessment of the audit evidence. It means not assuming management is dishonest, but also not assuming unquestioned honesty. Auditors must recognize the possibility that a material misstatement due to fraud could exist, regardless of their past experience with the client or their belief about management's integrity. Don't explain away red flags.
Healthy dose of doubt.
That's a good way to put it.
So what are the key audit procedures specifically related to fraud?
There's a whole suite. It starts with discussing the risk of fraud among the audit team. Then, obtaining information needed to identify those risks, assessing the identified risks and developing appropriate responses, evaluating the audit evidence gathered, especially anything that contradicts other evidence or raises questions, communicating findings appropriately, and of course, documenting everything thoroughly.
Let's dig into obtaining information. How do auditors sniff out potential fraud risks?
A lot of it comes down to asking the right questions. They make specific inquiries of management, the audit committee, internal auditors, and other employees about their knowledge of any actual, suspected, or alleged fraud, the processes for identifying and responding to fraud risks, and the controls management has established.
Talking to people.
Absolutely. And importantly, inconsistent responses to inquiries are a big red flag. They also perform analytical procedures, especially comparing recorded revenue to expectations, looking for unusual trends or relationships that might indicate fraudulent reporting.
Looking for anomalies in the numbers.
Exactly. And they evaluate whether the conditions of the fraud triangle, incentives, opportunities, rationalizations seem to be present.
So once they've gathered this info, how do they identify risks?
They synthesize everything they've learned and consider. What type of risk? Is it fraudulent financial reporting or misappropriation of assets? How significant is it? Could it lead to a material misstatement? What's the likelihood of it occurring? And how pervasive is it? Does it affect the financial statements overall or just specific accounts or transactions?
Okay, and I remember reading there's a specific presumption of risk auditors have to make in every audit regarding fraud.
Yes, absolutely critical. In every audit, auditors must, as a default, presume that there is a risk of material misstatement due to improper revenue recognition.
Revenue recognition, why is that always presumed risky?
Because revenue is often a key performance metric, easily manipulated, and historically a common area for fraud. Auditors also must presume a risk of management override of controls.
Management override,
Yeah.
because they can.
Because they're in a position to. These two risks must be addressed with specific procedures in every audit unless the auditor documents very specific reasons why they aren't significant risks in that particular case, which is rare for revenue.
Are there other additional considerations beyond those presumptions?
Yes, things like the entity's size and complexity matter, its ownership structure. Also, the susceptibility of specific items to manipulation accounts that involve significant judgment, complex accounting, or relate to significant unusual transactions are inherently more vulnerable.
Okay, so once risks are identified and assessed, there's a required response, and you said it's on 3 levels.
That's right. The auditor's response needs to address the assessed risks. Level 1 is an overall general response.
Big picture stuff.
Exactly. This involves things like assigning personnel with appropriate skills and experience, especially to high-risk areas, ensuring adequate supervision, evaluating the client's selection and application of accounting principles, looking for potential bias, and importantly, incorporating an element of unpredictability into the audit procedures from year to year.
Keep them guessing.
Right. Don't do the exact same tests every year. Level 2 is a response encompassing specific audit procedures.
Tailored tests.
Precisely. Altering the nature, extent, and timing of tests specifically designed to address the identified fraud risks at the assertion level. For example, if inventory theft is a risk, perform surprise inventory observations. And remember, tests of controls alone are usually not enough because of that management override risk.
Which brings us to level 3.
Level 3 is a response addressing risks related to management override. This requires specific actions.
Like what?
Auditors need to understand the company's financial reporting process and controls over journal entries. They must examine journal entries and other adjustments, especially those made late or with unusual characteristics, looking for evidence of possible misstatement due to fraud.
Digging into the entries.
Yes. They also need to review accounting estimates for biases. Look back at prior year estimates. Were they consistently overly optimistic or pessimistic? That could indicate bias. And finally, evaluate the business purpose for significant unusual transactions. Are they overly complex? Do they lack apparent economic substance? Are they designed just to achieve a certain accounting outcome?
Looking behind the curtain of complex deals.
It's the idea.
Now, as the audit unfolds, auditors are constantly evaluating audit evidence. What if they find things during field work that make them worry more about fraud?
That definitely happens. Conditions identified during fieldwork might cause the auditor to reassess their initial fraud risk assessment.
What kind of conditions?
Discrepancies in the accounting records, conflicting or missing evidence, problematic relationships between the auditor and management. Maybe management puts undue time pressure on the audit or denies access to records or people.
Red flags during the process.
Big ones. Also, results from analytical procedures that are unexpected. Even things like management displaying a disregard for internal controls or frequent changes in accounting estimates without clear justification. And remember, even finding immaterial fraud can be significant because it might indicate a breakdown in integrity or controls that could allow material fraud to occur.
So even small frauds matter.
They can matter a lot, especially if senior management is involved.
Which brings us to communications. If an auditor finds fraud, who do they tell?
There are clear protocols. Any indication of fraud, even if it seems immaterial, should generally be brought to the attention of an appropriate level of management, usually at least one level above those involved.
Go up the chain.
Yes. If the fraud causes a material misstatement, or if it involves senior management, it must be reported directly to those charged with governance, typically the audit committee of the board.
Directly to the audit committee. What about telling people outside the company?
That's usually not the auditor's responsibility. Confidentiality rules apply. However, there are exceptions. Disclosure might be required by law or regulation, like in filings with the SEC. It might be necessary when responding to a successor auditor's inquiries or in response to a subpoena, or sometimes to funding agencies or authorities if management and the board fail to take appropriate action on reported fraud.
Limited circumstances for outside disclosure.
Very limited, but important ones.
And naturally, all of this needs to be documented, right? The documentation requirement.
Absolutely. Auditors must document their understanding of the entity and its environment, the fraud risk assessment process, including those team discussions, the procedures performed to identify risks, the specific risks identified, the responses planned and performed, the results of those procedures, communications made about fraud. It's extensive. They even have to document why they might have concluded that improper revenue recognition wasn't a significant fraud risk, given the presumption that it usually is.
Document everything.
Pretty much. Proof of due diligence.
And much of this focus on fraud was really amplified by the Sarbanes-Oxley Act, or SOX, wasn't it?
Immensely. SOX, passed in response to major accounting scandals, had a huge impact. It established the PCAOB, introduced much stricter rules for auditor independence, required CEO-CFO certifications of financial statements, enhanced internal control requirements, and it imposed severe criminal penalties for things like destroying records or committing securities fraud. It also extended the statute of limitations for discovering fraud and provided important protections for corporate whistleblowers.
A real game changer for corporate governance and auditing.
No question about it.
All right. We have covered a massive amount of ground. Materiality, audit risk, fraud risk. Let's try and bring it all together now in this last section on the interplay. How do these concepts connect?
The most crucial connection is that audit risk and materiality must be considered together throughout the audit, from planning to evaluation. They are intrinsically linked. Well, think about that inverse relationship between audit risk and materiality at the planning stage. An auditor might accept a low risk of failing to detect a large, clearly material misstatement because their procedures are focused there, but they might need to accept a higher risk of failing to detect a small misstatement that's close to the materiality threshold, simply because testing everything is impossible.
So the focus is driven by the size of potential errors relative to materiality.
Exactly. The more material a potential misstatement could be, the lower the acceptable audit risk associated with not detecting it, which generally means more audit effort directed towards that area.
And how does fraud risk fit into this interplay?
Fraud risk is a key component of the risk of material misstatement, RMM. When auditors assess fraud risk factors, incentives, opportunities, rationalizations, and identify specific fraud risks like improper revenue recognition or management override.
That increases their assessment of RMM.
Precisely. A higher assessed fraud risk directly inflates the assessed RMM for the relevant assertions. And we know what happens when RMM goes up.
The inverse relationship kicks in, and acceptable detection risk, DR, must go down.
Exactly. So identifying significant fraud risks forces the auditor to perform more rigorous, more persuasive procedures, changing the nature, extent, and timing specifically designed to detect potential fraud. It directly impacts the audit plan.
So it's all connected. Materiality sets the target for what matters. RMM, including inherent, control, and fraud risks, assesses the likelihood of hitting that target before the audit. And detection risk determines how much work the auditor needs to do to have reasonable assurance they won't miss that target.
That's a perfect summary. This integrated understanding is what allows auditors to tailor their approach effectively and provide that reasonable assurance that users rely on. It shows you the depth of thinking behind that audit opinion.
It really does. It gives you a much deeper appreciation for the work involved in ensuring financial information is reliable. It's far more than just checking numbers.
It's about judgment, skepticism, and a deep understanding of risk.
And what a journey it's been today. We've taken this deep dive through materiality, really understanding what influences a user's judgment. We navigated the complexities of audit risk, the auditor's balancing act, and we shone a bright light on that critical challenge of fraud. Hopefully, you now have a much stronger foundation for understanding how financial statements get scrutinized and validated.
And maybe a final thought to leave you with. If knowledge truly is power, think about how this concept of materiality, what really matters to a reasonable user, what significantly alters the total mix of information might apply beyond finance, in the news you read, the data you see, even in personal decisions. What potential misstatements are you perhaps overlooking in your own life because, at first glance, they don't seem material enough to change your overall judgment?
Wow, that's a fascinating lens to apply. What total mix are we working with every day? Really makes you think.
Mm-hmm.
We hope this deep dive has given you that kind of new perspective. Keep asking questions, keep being curious. There's always more to learn and explore. We'll see you on the next deep dive.